Bloomberg Audio Studios. Podcasts, radio, news. Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Qualcomm gives an upbeat forecast, but it fell short of investor expectations. We'll discuss why with the CEO.
Plus, the earnings don't stop there. Executives from Figma, Robinhood, Chime and Lyft, they join us after reporting results.
And all eyes on Tesla as we await the outcome of a shareholder vote on a $1 trillion pay package for Elon Musk.
And Tesla, it weighs on the broader market, said. Let's get to those broader markets on the day because, well, overall, we've got a lot of macro data to be digesting, and that feeds in the angst that we've been seeing in tech stocks more broadly. We're off by 1.7% on the NASDAQ 100. We're still questioning valuations. It's interesting that the AI play moves into the macro in terms of jobs data, not coming from the federal departments, but it is coming from Challenger Gray and Christmas, and they're saying we've never seen an October as bad as this in 20 years in terms of 153,000 jobs losses. AI automation being blamed. Bitcoin off by 1.7%. We've got some risk aversion, Ed.
Yeah, in the chip sector, we have two very similar stories with two very different reactions. ARM has given us a bullish outlook for the current period, which basically suggests they're making traction in AI. The shares had opened a lot higher. We're now down 2%. Qualcomm, again, giving a pretty bullish outlook for the current period. Traction in traditional markets, diversifying revenue. But that stock is down 4% at the high end of estimates. They didn't quite get there. Then there's in the media and entertainment space. Warner Brothers Discovery actually missed estimates on revenue in the quarter, but amid plans for a sale or some kind of transaction, that's really all the street really cared about.
It is, and let's dig into that street reaction, the stock reaction. Hannah Miller's here to covering all things media. And really, almost these numbers vindicated the decision by David Zaslav to be separating out the businesses. Talk us through it.
Yeah, so this morning we heard David Zaslav really play up the strength of the studio segment. They had some big blockbuster hits this summer with Superman and Weapons. He wants buyers to look at the movie business, not the TV networks business.
Of course, Mr. Zaslav was asked about what happens next, and his response was pretty straightforward. We have an active process underway. Are you able to tell us any more, Hannah, about what an active process underway means?
Yeah, they want to move quick on this, and we're expecting to get more news in December about this deal. The bids have to come in. They have to consider all the interest they're getting from players like Netflix, Comcast, and Paramount. It's going to be really interesting to see how it plays out.
But Hannah, are they the names that we're limited to? Or could we see big tech throw its hat in the ring? Who else might be interested in a CNN on one side or more the studios on the other side?
Yeah, we're also, hearing whispers about Amazon. They could come in as they try to continue building out their Prime Video streaming service. There are these valuable assets. There is the focus on the movie business, HBO, but we have to remember that there's CNN, there's a valuable sports portfolio. There are some really nice assets up for grabs here.
Bloomberg's Hannah Miller, thank you very much. Let's get back to the chip sector. ARM gave a bullish revenue forecast helped by rising interest in designing chips to run AI data centers. Kunjan Sabani, senior analyst at Bloomberg Intelligence, writing, operating expenses remained elevated on AI investments and full chip initiatives, but long-term share gains and rising royalty content continue to support its outlook. Kunjan Sabani joins us now. ARM makes money in two ways. It licenses the blueprints, the underlying technology for a chip, and then it gets royalty in each unit of that chip that's sold. The story here is about what ARM is offering in the AI accelerator space or in the data center context. Explain what you saw in the numbers that they gave.
Yeah, the data center strength was really the highlight, as you mentioned, Ed. When you look at the royalty revenues from the data center, last fiscal year, it was about 10% of royalties. We expect this now to get to almost 18 to 20%, so a 2x increase in 1 year by the end of fiscal 26. What's really driving here in the quarter, they signed a lot of CSS license deals. Basically, they're licensing their IP to a lot of data center customers, whether it's been the merchant customers customers, the ASIC designers, SoftBank, and even Chinese customers. A lot of these licenses will eventually get converted into royalty revenues, hence creating a tailwind for layering more and more royalty revenues. Their share is significantly increasing quarter over quarter, and is, as we know, NVIDIA is going to launch their servers with the Blackwell. The Blackwell servers, are the CPU in that servers are going to be based on the ARM IP. When you look at Amazon ramping its Graviton chip, that's based on the ARM IP. Google's Axiom chip based on the ARM IP. So they're seeing significant share gains here, which eventually sets them up to have strong royalty growth in the future from the data center segment.
Kunjan, you mentioned SoftBank, and of course SoftBank is the main owner of ARM. Some of it trades on the public markets. SoftBank, big player in just the broader AI space, Stargate, for example. Did you get enough detail from Rene Haas, the CEO of ARM, about their role in Stargate and the big build-out?
We did. So if you look at the numbers, this quarter, software brought in somewhere about 180 million in royalty revenues, 50 million jump from just last quarter. Also, when we look at the revenues by geo, Japan is becoming now almost 15 to 20% of revenue, which until a few quarters ago, Japan was merged into small category other. So that tells you that the amount of revenue, both from royalty side and licensing, that SoftBank is bringing into this company and going to become a significantly big concentrated customer going forward. Software has a lot of portfolio companies. They acquired GraphCore, Ampere. So you can imagine it's a leading indicator of where they would be using ARM IP. Also, there's news about software and working with ARM to sort of develop their own chips.
Qualcomm, strong outlook for the current period, suggests strength in Android and efforts to diversify revenue sources, doing well. We're showing your research on the screen, Kunjan. Very quick, give us your react.
Yeah, it was a good quarter, but the concern here is that the fear that they would go back to 75% of share at Samsung comes to be coming true. So that's, I think, what investors didn't like. We think that Apple share is higher than what we feared, 70. It's close to 80 to 85%, but that goodness got offset by the Samsung share drop.
Kunjan Sabani, always great research from you and the team. We appreciate it at Bloomberg Intelligence. Shares of Qualcomm. We check in on them because they reported last night. They're trading a little bit lower today, but the chipmaker actually really delivered an upbeat forecast. They had sales and profits handily topping Wall Street expectations, but maybe the market had got ahead of itself. Let's talk about it all and the real fundamentals with Cristiano Amon, he's Qualcomm CEO. And I'm sure it's really frustrating to start on the stock market reaction, but what do you think investors had done ahead of this? Had they got overexcited? We're seeing this play out with a few of the chip sector.
Look, it's really hard to predict the market right now, but we're incredibly happy about the company. I think we're executing very well. Our strategy is playing out perfectly. Everything we said we're going to do, we're actually doing better. And I could not be more excited about so many things that are going well at Qualcomm right now and the new opportunities we have in the future. I think the company is very different. We had expanded beyond handsets into a number of different markets. The results are showing. And there are very few companies like Qualcomm that can go from 5 watts chips for earbuds all the way to now 500 watts chips for a data center. And I think that's how we think about the opportunity.
We can't wait to get into more on the detail of how you're jumping into the AI accelerator offering. But just going to the smartphone business, which is the bread and butter, what are you seeing at the moment? And particularly, what inroads are you making in Android?
Yes. So, I think this is a very interesting, and it's, every quarter we see this. I know there's a lot of conversation about it, but it's a trend that has happened to Qualcomm over the past several years. I want everybody to step back and look at what's happening with the handset market in general. The handset smartphone is the most important consumer electronic purchase in the world. It's our inseparable device. And people want always to get a better device when they buy a new device. What we see right now is the expansion of the premium tier. So the market, Caroline, the units of handset market is still smaller on an annual basis than used to be before COVID. But what has happened and is driving a lot of growth from Qualcomm and Android over the past several years is the premium tier is expanding in size. So if you look at the United States market, most of the devices are premium tier. Most people will buy like an iPhone or a Galaxy. That's now happening everywhere in the world. It's happening in China, it's happening in India. So we see premium tier expanding. That makes, a much richer market for us. And then we see phones becoming more capable, more compute, more AI that is driving silicon content. That's why Android continues to grow with Snapdragon 8. And I think the upside that we have seen above expectations is really Android expansion for Qualcomm.
Cristiano, good morning. It's Ed. What you've tried to do is diversify away from mobile and away from Apple, right? But there are so many categories. Now data center, but auto, mixed reality. Which of those is the fastest moving for you right now?
Look, right now, you probably see in terms of the speed, it's automotive. I think we have been growing significantly on a year-over-year basis, and most of our growth, again, like the conversation with handset, has nothing to do about the market size. It's just us gaining share. Those cars becoming really computer on wheels, and we build a digital platform for the car industry, which is the Snapdragon digital chassis. So when you talk about diversification away from handset and Apple, a couple things that actually came out in those results that are incredible. And it show what we've been saying we're doing it. We just closed our fiscal year. The non-Apple related growth in the company of about 18%. And when you look at segments like automotive, we're actually doing significantly higher than that. And that's also the other segment as well. The other part of the question is what's moving faster? And we are incredibly optimistic about those new category of mobile devices, which we call personal AI devices. As AI models and agent applications started to appear for consumers, that's materializing with devices that people wear. Like glasses, for example, are really becoming agentic glasses. And we said $2 billion of revenue by fiscal 29. We're way ahead of that. Just looking of how is it performing right now, especially with Meta.
This is the first opportunity we've had to speak to you since the big data center news, AI 200 to start. And the question that I've had most often for you from the audience is, what is different about Qualcomm's approach, particularly to inference? You have this AI accelerator family, or NPU. How is it different from an NVIDIA or AMD GPU, a Broadcom Marvel XPU, or this large body of startups that are basically chasing rack-scale solutions for AI?
Yes. So I'll start answering the question by saying the following. There's a lot of people that will love Qualcomm. There are people that are not going to like Qualcomm. But one thing everybody's probably going to say, don't bet against Qualcomm being a technology competent company. I think, look, just last year we're the #1 company in America in terms of patent applications. And every market that we actually enter, we actually develop something very unique from a technology leadership. So now to answer your question, what are we doing? We're very focused on the next phase of data center. The next phase of data center, if you expect all of those projections to materialize and all of those companies investing in data center and AI to deliver the profitability the market expects, they're going to have to do inference. Inference is actually when you put AI into production at scale. And if you see just some of the conversations you see in the market right now about concerns of growth rates, power is one of the concerns. You need a lot of energy. So we coming from our DNA of building devices, they're very efficient in power, and we think about what are the architecture that is dedicated for inference, especially for the post-GPU, I think, architecture. And I think that's what we're doing. I think we're developing an architecture that is optimized to the highest possible compute density you can put on a data center for a very efficient power. And people are interested, and we're just busy executing. I think the other part of the answer, Ed, is why you not think that Qualcomm will have an opportunity to participate? The market is so big, we don't have to get a lot. Everything we get is multiple billions of dollars.
Cristiano, you brought up a really interesting if some of the big numbers that are being bounded about by the big players come to light. $3 trillion by 2028 is what Morgan Stanley thinks is going to be needed in data centers. What if it doesn't? Is there a risk that we actually innovate because we have to innovate because there isn't enough power and suddenly that data center demand just isn't going to live up to that expectation?
No, for Qualcomm, for us, it's all upside.
So, but do you think, can I just get a take on whether you think that $3 trillion figure even is reasonable? Do you have any negative worries, any concerns?
Look, I don't. I believe that the need for compute is very clear. That's not only on the data centers everywhere. I think we see that on phones, we see that on cars, we see that on PCs. AI needs a lot more computing power, and I believe what that will actually do is create opportunity for innovation, and there will be competition. Right now, everybody's playing to win. Everybody's building data centers to win, and then there's going to be competition, and I think that's what our focus is. But I don't believe the trend and the need for a computer. You can have an argument about the timing, but the trend is very clear. Here's one way I'll describe it to you, and I'll be very careful with my words. The internet, when we thought about what the internet will be back in 1999, is bigger today. The internet's much bigger today than people thought. So I think on the long run, AI is probably underestimated, is going to be bigger. The question is always going to be about timing, and we're preparing for when there's going to be competition.
Cristiano Amon of Qualcomm, great to have you back on the show. Thank you very much. Figma delivered an upbeat outlook, projecting stronger than expected quarterly revenue and profit, citing strong demand and growing adoption of its new products. I sat down with CEO Dylan Field, who began by explaining the impact to growth from acquiring Weavy, a startup focused on generating imagery with AI within a web browser.
Weavy is this amazing product where you can bring in all sorts of models. You can compose them in a node-based system, which basically means drag and drop visual programming. And from there, you can really start to explore what's possible with various models. So for us, it's a bet that the starting prompt is just the starting prompt. It's not the end. What you need to do is shape these outputs almost like a medium, like clay, rather than try to go for the one shot. And then the final destination should be what you get throughout this process. The team itself is incredible. I mean, they've managed to really balance simplicity with power so that they're able to achieve an incredible environment for creative exploration and process and workflow building. And really excited to work with them and build this out further.
It brings me back to the customer behavior question. So revenue for the full year will be $1.044 billion to $1.046 billion. But I guess is this existing customers using more products, or is it a customer count growing higher because you're offering a wider range of products?
Yeah, definitely both, and also new customers adopting. We are seeing an acceleration and all that, and our NDR, for example, went from 129 to 131% this quarter, and that's on over 10K ARR customers. The way that we look at just what's going on overall is people really like the platform aspect of Figma. And that is something that drives adoption, but also the interoperability between the different products we have is really important, and something that we're trying to make all the better all the time.
In the quarter gone, net losses were driven by stock-based compensation.
Yeah, the one-time event related to the IPO in particular.
Related to the IPO in particular. But, stock-based comp is part of this business in the world of technology, but it's also like part of the fabric and culture of the technology industry, particularly now where we have this fixation on AI talent. What is your strategy going to be from this point, Dylan? Just less stock comp, or you'll just have to manage it differently?
Well, I think that, first of all, it starts with making sure that you see and everyone sees stock-based compensation as an actual expense. And I think that as we build out, we will see that number normalize. On a non-GAAP basis, this is a profitable quarter for us, and we continue to invest heavily in the short term in order to drive long-term platform growth and capabilities for our customers. I think that every customer wants that, and our investors want that as well.
Dylan Field, Figma CEO, with you, Ed. Meanwhile, Robinhood also reported earnings yesterday. Shares actually falling this morning, though. The company's crypto earnings, they were lower than expected. Meanwhile, operating costs, they were higher. Now, Robinhood CEO Vlad Tenev sat down with us yesterday and discussed the trading platform's plan to expand its offering.
The interesting thing about prediction markets is it rounds out the offering and sort of like completes the time at which Robinhood customers can continue to engage with the platform. For a while, we were offering predominantly U.S. equities, which is very much a U.S. East Coast working hours type of event. Markets are open, 9 to 4 East Coast hours. And then we've expanded that over time with us introducing 24-hour market. We've added crypto. And now prediction markets, a lot of the events, particularly in sports, are happening nights and weekends. So Robinhood is becoming increasingly a 24/7 platform where you can trade and invest in global markets at all times of the day. And I think our customers do tend to be digitally native and quite savvy. That tends to lean younger. But we also have customers that are, in their 70s and 80s. And as long as you're comfortable doing your finances on a mobile device and you want to be at the frontier of technology, I think it's something that transcends just young people. Of course, we always want to be relevant to the next generation, but Robinhood, I feel like you should be at a disadvantage if you're using any other platform.
That was Robinhood CEO Vlad Tenev speaking after the company's earnings call yesterday. Now, coming up, AI seems to be taking a toll on US jobs. We'll talk about the October labor cuts next. This is Bloomberg Tech.
Time now for Talking Tech, and first up, Apple is turning to Google for help overhauling its Siri voice assistant. Now, the iPhone maker is planning to pay about $1 billion a year for an ultra-powerful 1.2 trillion parameter AI model, according to sources. Now, the hope is to use the technology as an interim solution until Apple's own models are powerful enough. Plus, AI looks to be making its mark on the US labor market. Last month saw the most job cuts by US firms for October in 2 decades. It's all according to data from Challenger Gray and Christmas. Look, the firm pointed to AI reshaping industries, but also acknowledging the impact of cost-cutting and right-sizing post-pandemic. Ed.
Okay, coming up, Tesla shareholders have voted on the proposed $1 trillion pay deal for Elon Musk and his future at the company. After the market today, we'll find out the results of that vote. Stay with us. This is Bloomberg Tech.
Companies worldwide are projected to spend $375 billion on AI infrastructure in 2025, with that figure increasing to $500 billion in 2026. Meet New Era Energy and Digital, a NASDAQ company, symbol NUAI, delivering energy-resilient, AI-native infrastructure, supporting the next wave of AI growth in Texas. Announced MOU for 1,600-mile high-capacity fiber network across Texas. New Era Energy and Digital, symbol NUAI.
Hi, Julie. It's Pam. Listen, I just saw the storm warning and they're saying it could be bad. I know the store is going to be a madhouse, but we need to stock up on food. We also need gas for our generator, or we're going to be stuck without power. Please make sure you have everything you need before it's too late. I don't want you getting caught unprepared.
For Patriots, everything you need for total peace of mind.
Oh, why does my back hurt every morning? I stretch, I cold plunge. I even invested in a $5,000 mattress.
Well, you sit on this all day.
How did you get in my house?
The only way to fix your pain is to fix your sit. The Anthros chair is built around the true science of sitting.
Okay, but my chair has lumbar support?
Lumbar is a low bar when it comes to judging how a chair supports you. Research shows the real foundation of a healthier sit is pelvis support. That's why we created our patented precision posture system that supports the upper and lower spine independently based on your specific body shape.
Nice. 2 for 1.
With your pelvis supported, you can experience pain relief in your back, neck, and hips, improved posture, and the ability to sit through even the longest of work calls just to unmute and say,
Nope, nothing from my end.
fixing how you sit is the easiest healthy habit you can build. Try the Anthros chair, risk-free for 60 days.
Put up Christmas lights for the last time with App Lights Permanent, the affordable year-round lighting solution. Snap-on detachable Christmas bulb covers for the holidays, then remove to transform to everyday accent lighting. Choose from millions of color and effect combinations using the free app. The starter kit includes everything needed for easy, permanent setup. Install once, enjoy endless possibilities all year. Visit www.applights.com or get yours today at Walmart.
Let your feet take you wherever your spirit wants to go. The redesigned Hurricane helps you navigate any surface so it truly stands alone. Scan the code now or go to hurricane.com.
I do not believe any company anywhere near this size has ever delivered a compound annual rate of growth for EBITDA, which is a bottom line number, of 41% over 10 years. No company has done that. So, yes, indeed, the incentives are aligned. If he and his team are able to deliver on that number, the stock is going to outperform enormously.
Kathy, if by chance this proposal is rejected, would you consider shedding some of your Tesla position?
So I'm happy that the prediction markets are at 90 to 95% in terms of this is going through. So we don't have to think about that. Clearly, if Elon left, we think about it in two ways. One, we think robo-taxis, he has them at the starting gate as of June, and now they're rolling out. And that AI project is well underway. If he had left 5 years ago, 3 years ago, it probably wouldn't be anywhere near where it is. What we now think, though, is in order to capitalize on humanoid robots, which that's a much more difficult project, that, yes, Elon's brilliance and the team he has attracted around him are going to be necessary to pull that off.
That was ARC CEO and Tesla shareholder Cathie Wood, her firm voting yes on Elon Musk's $1 trillion compensation package. What about firms that voted no? CalPERS, the largest public pension fund in the US, voted against the pay package, citing the fact that the deal was far larger than CEO pay packages at comparable companies. Drew Hambley is their investment director and joins us now. Wood's argument there, Drew, which you heard, is that if they continue and achieve the EBITDA goals that this proposed package is set for Musk by the board, then the outperformance of the stock will make it in the interest of shareholders. You don't agree with that. Why?
Well, thanks, Ed. So, we can't predict what the market's going to do, and we're evaluating pay packages. We look at them vis-a-vis other comparable companies. So let's say he does achieve all those goals, but say the market does as well, too. Are we really paying for alpha, or, is that a market beta? When we looked at the last 8 years of returns, going back to when the original package was put into place, Tesla was one of our best performers. It wasn't our best, but it was in our top 10. And then when we compared, the annualized pay of the $96 million they want to give him in the restricted stock award that vests in 2 years, and then we looked at median pay of these other high performers in our portfolio, and that piece of the package alone is 73 times the median of other high-performing companies and CEOs in our portfolio, and we just thought that multiple gap was too high.
Drew, the board is going to argue, they have argued on this program, that Tesla is not comparable to other companies. Elon Musk is the only person on the planet who has the skill set, is what Robin Denholm told us. The real point of tension that you have with others is the concentration of voting power. You said at the time that you cast the vote or confirmed it, that it put too much concentration of power in a single shareholder. That's exactly the rationale that Elon Musk is proposing investors vote in favor of the package. He wants the voting power in order to achieve the goals that the board have set him. How do you reconcile that going forward?
Well, we look back, and at one point he owned 25% of the company and then sold off half of it, and they've achieved goals with him being a 12 or 13% shareholder. So I don't see diluting shareholders by another 12 or 13% changes the dynamic. He also is a person with a huge stake in this company. I don't see why he would want to do anything that would damage it. So I don't see why he needs any extra control over what he already has. I mean, he and the board together own about 16% of the company. And, we don't think diluting ourselves by another potentially $1 trillion, changes that dynamic.
I suppose Elon's argument has been they're at this inflection point. And it's moving not just from cars, and they still want to have, 20 million cars on the roads, but it's going into the era of AI and into humanoid robots and the army of robots he's going to be producing. Would you want him to have the most say over an army of humanoid robots?
Well, I think he already has tremendous say as the largest shareholder of the company. As a, governance person, do we want so much risk in one person? Maybe he is the visionary that the board thinks he is, but we don't know what could happen to anybody. And to have this much risk placed in one person and to dilute ourselves just to one person, there's tens of thousands of people working at Tesla creating value. And if it is, so key on just one person, key person risk, that's a worry for me as a shareholder.
You are all about stewardship and of the pension fund holders that you report to ultimately, but you've done this job for a long time over at Morgan Stanley and other players. If Elon Musk was to walk, would that be in your role of stewardship? How do you manage to balance that out of what the risk is if indeed he did leave?
Yeah, so we do think of ourselves as long-term shareholders, and a lot of our portfolio is indexed, and so we plan to hold this company for a long time. So we try not to worry too much about if one person leaves today or tomorrow. We're in it for the long haul. So if he left tomorrow, would that be a short-term hit to the business? Possibly. But if we're going to hold this company for a long time and the board has to replace him and get somebody in terrific, maybe not as good as Elon, but pretty terrific, we still think we're going to benefit over the long term by holding this stock.
Drew, we got many, many questions from our audience for you. One of them was what Caroline just asked, what happens if Elon leaves tomorrow? I think the other one is people would really appreciate an explanation of the criteria by which you cast your vote. So you explained on the comparisons, historic patterns. But one way that it was put to me is, in the context of CalPERS, is, do you understand the company? Did you look at the mandatory goals set by the board and say, okay, this could be to the benefit of the stakeholders in our pension plan?
Yeah, and we evaluate every pay plan, case by case, and so we did look at those things. And what we're trying to do when we're, paying a CEO is what part of that return is beta, and then where is the actual skill. And so it's hard for us to predict what the beta is going to be 10 years from now at the end of this award period. And, he might do very well. He might increase it by 6 times. The market could go up by 6 times, and that would be, how would he be any better than anybody else? And so to give up that much control and dilute ourselves that much for one person, we think is a risk as well.
There's a risk that he might never achieve these goals, and you've seen that with other similar pay packages, Echoed, we've seen it at Airbnb, we've seen it at other players where they haven't managed to top the goals. Do you think 1 million robo-taxis is achievable in the time frame? Do you think the FSD is? Do you think the cars are?
Well, it's possible that all those things are, and I think this time, too, the competition is greater than when Tesla came to market with their first car in terms of EVs. You have Google working on robotaxis, you have the Chinese working on them. So it's going to be a more competitive marketplace. Certainly they are in a position to be one of the key players in this. But, 10 years from now, we might be talking about, 3 other companies that dominate robotaxis. That's hard for us to know today.
Drew Hambley, it's been great speaking with you. Thank you for your time. Investment Director for Global Public Equity over at CalPERS. Now, let's take a quick look at the broader markets right now. Tesla is actually a key drag on the Nasdaq 100. We're off by 1.8%. There's also the macro data, the jobs data that's got people a little bit worried for the month of October coming from Challenger Gray and Christmas. Let's move over, though, to some individual movers because earnings have come thick and fast. And boy, have they moved the stock. DoorDash actually having a record drop at the moment. This is after their numbers came through that really, in echoing to Uber, they are reinvesting in the business, reinvesting in Deliveroo, but that's going to crimp margins and therefore maybe not the growth story that many had anticipated from a margin and profitability perspective. It's off by 15%. Snap, though, gets a little bit of AI love. Why? Because, well, they've got to deal with Perplexity, surging on that $400 million Perplexity AI deal. And we see it up almost 10%. Datadog as well, having a pretty phenomenal day, up 21%, Ed. This is as a software company, look, manages to keep on selling, even though we do see a whole new era of AI cohorts coming for the eat their lunch. Thus far, they're not eating it.
This is Bloomberg Tech, and you're looking at a live shot of the principal room. Check out the Bloomberg Tech podcast. You can find it on the terminal as well as online on Apple, Spotify, and iHeart. This is Bloomberg.
Back to earnings now. Chime. It's just posted strong member growth, stable revenue per member, and disciplined cost execution. Earnings, they beat expectations. It raised guidance. It announced a share buyback plan. And yet the stock falls. Chime CEO Chris Britt joins us now. And you clearly think your shares are undervalued. That's why you're thinking about up to a $200 million share buyback, Chris. How do you digest this sort of market move now you're a public company?
Well, thanks for having me on, guys. It's great to be with you again. I remember being with you on our IPO day. Yeah, look, we're a recently issued stock. We've had 2 quarters now where we've the team's done an amazing job executing. We just announced 29% revenue growth year over year, 21% growth in our member base. We added 400,000 new active members. And we're improving our profitability profile at the same time. So we feel like we're executing really, really well. And I think it's incumbent upon us as a newly minted public company to just continue to educate our investor base on the enormous opportunity ahead of us. There's about 200 million Americans that make up to $100,000 a year that are not well served by the incumbents. And so as a newly minted public company, there's always a little bit of volatility in the stock, but I think it's incumbent on us right now just to continue to execute. And if we do that, I think the share price will take care of itself.
It is a macro picture that perhaps you fight here. We're suddenly worrying about fourth quarter. We're worried about a consumer, particularly perhaps a less affluent consumer, that is really the area you're trying to serve right now. What are you seeing in your customer base?
Well, we actually are serving the 70% of America that makes up to $100,000 a year. So this is a very large segment of the population. And if you look at our member base, the fastest growth that we're seeing is in the 75 to 100K earnings segment. And I think that's because of some of these new products we just launched, like our Chime card, our new Chime card, which is a rewards card that gives 1.5% cash back on everyday spend and 3.5% on your savings account. But I think it is true that there's a bit of a malaise over a lot of consumer stocks that maybe investors feel like are going to have a lot of pressure given the tightening of the economy. As it relates to what we're seeing, we see a very healthy consumer. We don't see an uptick in unemployment or unemployment benefits coming to our accounts. We actually are seeing an increase in discretionary spend across our member base, and people are, going out there. We're seeing double-digit increases in places like Costco, Amazon. We're seeing people go to restaurants more. We're seeing people use DoorDash, Uber Eats, paying for convenience. So we're not seeing the pressure that I think some companies may be experiencing out there. We see a fairly healthy consumer, actually.
Chris, can you talk about how you're getting new customers to use more than one product? I think what's interesting is you are letting new clients who might not have a sort of direct deposit set up with you experiment with MyPay, for example. Are you seeing evidence that they then go on to use other things?
Absolutely. We continue to see, if you look at our cohorts, and we have this in the supplemental portion of our earnings, you can see that as our cohorts age, they continue to not only adopt products at a faster clip early in the relationship, but they also continue to throughout the life cycle. And over the course of, these are primary recurring direct deposit relationships that we've really honed in our business model of being able to cultivate. And that leads to many, many years of recurring revenue and more engagement over time. And as a result of that, you see expanding average revenue per active member. But yes, it's true. We're doing everything we can also to make our accounts easier to use right out of the gate. And we've seen a lot of success with getting people to fund accounts and then eventually convert to direct deposit later.
Chris, quickly to finish, what's the next new product frontier for Chime?
Well, we announced on the call a great development for us, which is that we converted all of our processing onto our own internally built tech stack called Chime Core. This is a huge unlock, not just a significant cost savings advantage for us, but also it will unleash a new era of innovation for us. We announced a number of new features that we're looking to launch over the course of the next year. We just launched our Chime card that I explained earlier. We're going to launch joint accounts, custodial accounts, investment services, and importantly, we're going to continue to add more tiers so that our more premium members, those that engage with us the most, and higher earning consumers get even more when they bank and do their everyday payments with Chime. So you should expect to hear more on that front as well.
Okay. Chime CEO Chris Britt, great to have you back on the program. Thank you very much. Now, coming up, we're going to speak with Lyft CFO Erin Brewer after the company's latest earnings results. You don't want to miss it. This is Bloomberg Tech. Shares of Lyft up about 7%, on track for their biggest jump since mid-September. The company projected an acceleration in bookings this quarter, easing investor concerns about the company's global expansion efforts. Here with more is Erin Brewer, Lyft's CFO. I think what will be really interesting is, okay, this current period, the outlook is strong, but what are the underlying behaviors that you're seeing driving that from riders and the different products that they're using?
Absolutely. A couple things. One of the nice things is this acceleration and the foundation of our performance is multifaceted, really. So we reported in the third quarter an 18% growth in active riders. And yes, that does incorporate our recent acquisition, but even in North America, we're seeing the strongest active rider growth, hitting all-time highs. That's led to gross bookings at all-time highs, adjusted EBITDA up 29% for the quarter, and then $1 billion in trailing 12-month free cash flow. We've got our partnerships with the highest penetration rate ever. That's even before we announced the United Airlines deal. Right. We've got, of course, the acquisitions flowing in, and we've got loyalty programs that are, differentiated in the industry. And all of this is driving, again, highest retention rates ever.
So your job's difficult. It's great to have you on the program, and when we have a CFO, you have this balance, right? Investing for growth and then discipline. So in Europe, that's been the strategy. Invest, M&A. In the United States, you're chasing Uber, and you need to be disciplined, and you're very keen to talk about the bottom line performance. You personally, how are you managing that right now?
Yeah,
what's the priority?
Absolutely. A couple things that I would say. Our market is so large, right? That's what we focus on, the penetration and the opportunity that exists broadly in the market. 300 billion personal vehicle trips that exist across the markets we serve. We're not even close to getting, as an industry, even let alone Lyft, where we can potentially be. As it relates to investment, You know, it's pretty easy when you're in a growth industry because you've got lots of opportunities. So you're right, as a CFO, you're thinking about how do you do that in a disciplined manner. The great thing is we're sitting here today in a position with the strength of our free cash flow to be able to do that, to take advantage of opportunities where we can drive shareholder value. We've also been buying back shares. We'll complete a $500 million share repurchase in 2025. So a nice balance, and we see that continuing going forward.
The opportunity many see, Erin, at this moment is AV. And you've taken interesting partnership routes. You're also doing things with Baidu. And there's a real commitment here to almost own part of the fleet of robo-taxis. How does that change sort of an asset-like model that you've had thus far?
Yeah, you know, one of the things I think that's really interesting to highlight is that Lyft today owns cars across multiple cities in the U.S. through our subsidiary FlexDrive. Drivers can come and rent. So we really understand this model of owning assets. We have assets on our balance sheet today. And of course, as the AV market develops, and we've been very purposeful about the partnerships that we are entering, you know, we're absolutely going to do that in certain cities as we scale, as we learn. Baidu, as you mentioned, is a portion of that. We'll be doing a little bit of that in some of our other partnerships. So it's something, again, we know how to do. We still see ourselves long-term as an asset-light company, but as the industry develops, we're going to make some of those investments.
What's interesting is I think it's by 2027 you want some of these AVs on the road. I mean, Uber's got a commitment for 100,000 car goal by 2027. How realistic are these, Erin?
You know, that's, you know, I'm not going to comment on necessarily their goals, but we absolutely see if you might, you know, look 5-7 years down the road, you know, perhaps 10% of the volume we serve could be served through AVs, both the combination of partnerships that we're in and maybe assets that we own. So it's a huge opportunity. I think the other important thing in that stat, though, is you're still going to see huge volume served by drivers. That's why we're really focused on the hybrid network. That's what's going to make the difference and be economically viable.
Erin, very quickly, what's the timeline to integrate the chauffeuring business into the core Lyft app, if at all?
Well, look, it augments what we've been growing in terms of our own business. We have high value modes, premium modes on our platform today. They're up 50% year over year in Q3. So this is a great extension to, you know, continue to build out that offering. As it relates to the way that TBR Global Chauffeuring will operate, they've got incredible clients all around the world. It's a fantastic business. It's not going to be on the app in the near term, but the synergies that we see with the 1,500 independent fleet operators that they engage with across the globe, we're going to drive some synergies there, and the service capability they bring to our company is incredible.
Erin Brewer, a joy to have you on the show. Thank you, CFO.
Thank you. Thanks, Carolyn.
Lyft.
Thank you, Ed.
Stay well. Meanwhile, Ed, that does it for this edition of Bloomberg Tech Earnings Thick and Fast.
Earnings thick and fast. There's a lot more to come. Musk pay vote after the bell. Check out the pod. Shout out the pod. Lots of you listen to the pod. You know where to find it. It's on all the Bloomberg places and on the internet that we're listing on your screen right now. Have a great afternoon. This is Bloomberg Tech.